Hey, if you are considering getting a quality of earnings report for a small business that you're looking to acquire, and you may have come across maybe something called like a quality of earnings light, or something that we offer, a quality of earnings sniff test, we call it. But there's kind of this like full quality of earnings report, and then something less than a full quality of earnings report that different service providers offer. And a lot of times I've been getting questions about, hey, what's really the difference? Like, why is there a difference in cost? Because there's a pretty significant difference in cost. And what's really the difference in the deliverable? What does one service do that the other doesn't? And so in this video, I just wanted to highlight what a full quality of earnings report can do and what isn't included in kind of a light service, but how a light service might actually still be useful for what you're trying to accomplish with your acquisition. So at a high level, what a quality of earnings report is looking to accomplish is to help you understand how likely this business that you're acquiring is to continue earning the same amount or similar earnings as it has in the past. Right? So if it's earned, $500,000 in profit last year, how likely is it to continue to be able to do that? And so it's diving into the financial details to try to help understand that. How reliable is that? And I'm going to give you a few different examples today to kind of highlight what we might do in a quality of earnings sniff test versus what a full report process would look like. So let's look at some examples here. I'm going to pull up our quality of earnings sniff test spreadsheet here and use that to kind of demonstrate a couple of examples here. Okay, so in this example, we have a tab here, revenue analysis. So just at a very high level, what we're doing in a kind of a quality of earnings light offering, we're getting in the historical revenue numbers. And, we're just going to point out like, hey, what happened here? We had 8.5 million in revenue down to 7.2, now back up to 9 million. Like, what gives? Like, why the pretty significant fluctuations here in revenue? And so we are going to try to help you figure out what questions you need to ask to understand that. In a full quality of earnings report, what they're going to do, or what they're more likely to do, is to ask the seller. They're really going to talk to the seller. They're going to ask for source documents. So they're going to want to know, especially if these sales are related to contracts or specific projects, they're going to ask to see the contract. Did you have a big contract with Amazon to help, construct a new warehouse or do the electrical wiring at the new Amazon warehouse here, and then that contract ended, and then you got another contract the next year from Amazon. And so like, is it just the timing of contracts? Like, is that the big thing? Or what does the pipeline of contracts look like in future years? Do we have any big customer concentration? They are going to look at the source documents and they're going to investigate those. They're going to read contracts. With a quality of earnings sniff test, we're not going to do that. We're just going to say, hey, you should look at that. Like, this is concerning. You should ask and make sure you understand that as a buyer, right? So we're pointing out red flags or concerns, but we are not reading contract documents, right? Another example can be on the expense side of things. So an example I often like to use is, let's say this car and truck expense here for this business. So what we can see based on, we'll pull industry data and we'll say, based on the similar industry data, businesses in this industry are spending 7.72% on car and truck expenses, and this business that you're buying is only spending 2%. Now, let's say this is, let's say it's a or business, or maybe the business has trucks or vehicles. And so a question might be, why is it so much lower? Are they not doing preventative maintenance? Are they not doing repairs as they should be? And so, what we're going to be looking at is just pointing that out, that this doesn't match industry standards, and you should dig in and ask those questions. Again, in a full quality of earnings report, they might say, send us your preventative maintenance logs for all of your fleet of vehicles. Send us the mileage on each vehicle, so you can have some understanding of, like, the minute you buy this business, are all your company vehicles going to are they all going to break down? Is there a whole bunch of deferred maintenance that needs to be done? So again, we're going to point out this is something you should look at in a full report. They're going to dig into the detail and really, it's not an audit, but it's similar in the sense to like getting to the source of it and really trying to understand. Okay, so a third and final example I like to talk about often is digging into Addbacks. So what you might experience is that the seller is going to be trying to calculate the seller's discretionary earnings, SDE, you hear it called. And the way that is calculated is you take like the profit of the business, and then you might add certain things back, like owner's compensation, officer's compensation. So let's say I own a business, it did $300,000 in profit, but I also paid myself $200,000 a year. And that $200,000 a year, let's say that's showing up in this payroll expense line item. And so if that's the case, if it's showing up in payroll expense, what you would do is you'd add back that $200,000 and say, well, once you own the business, you're not going to pay me anymore. So this business is really, instead of just $300,000 in profit, it has $500,000 in profit or $500,000 in seller's discretionary earnings, because that $200,000 that I pay myself is going to come back to you. So that might be the argument, right, that the seller is using to value their business. So they're saying, okay, it's really $500,000 worth of profit, and we'll base our valuation on that. Now, what we would say in a quality of earnings sniff test would be, okay, so the seller is paying themselves $200,000, but what jobs were they doing in the business? And when you take over the business, are you going to have to hire somebody to do all of those jobs or some of those jobs? And if so, how much is that going to cost you? So you might realize, hey, it's going to cost me $100,000 to find somebody to do the job that the owner was doing that I can't do. And so I'm going to have to hire that. So really that add back of 200,000 really shouldn't be 200,000. It should be maybe 100,000, right? And so again, in the quality of earnings sniff test, we're going to say, hey, we're going to give you that kind of insight and say, hey, you should really dig into that. What was the seller doing? What's the replacement cost? Now in a full quality of earnings report, like they may really, really dig in to try to understand, like, really what was the seller doing? And they might realize, like, oh my goodness, they were doing so many things, and you're going to have to hire 3 people because they were wearing all these different hats, and you're going to end up paying $300,000 in payroll. So the earnings of the business is going to actually get even worse. And they're going to try to kind of prove that or demonstrate that with the numbers, right? So again, kind of key differences there. We're trying to point out red flags and areas where you need to dig in. And the full report, they're probably going to do the digging in for you and really try to prove that. So one kind of thing I like to show, though, is that what we are ultimately doing in the quality of earnings sniff test, we kind of think of this as a pre-letter of intent. So before you sign a letter of intent, this offering can be really useful to help you understand what are the red flags and does the deal seem to work. And so what we'll look at is we'll look at the details of the deal. How much working capital are you going to need? What's the purchase price? So kind of a total cash need. What's your investment? How much debt is going to be needed? How much is the seller going to provide as a seller note? And then ultimately, how much of a bank loan are you going to need? Based on that and the various assumptions here, we can then see what the debt service coverage ratio is going to be. And the SBA or any bank lender is going to want a debt service coverage ratio of probably at least 1.25 or higher, meaning that you have $1.25 of earnings for every dollar of debt service that you're paying. And so what we're trying to help you do is like make sure that this deal pencils. So you put in all the details of the deal, and based on the purchase price and the seller note and all of these things, are you going to have a debt service coverage ratio of higher than 1.25? If not, something has to give. You might have to lower the purchase price. You might have to raise more equity. You might have to lengthen the term of the loan or lower the interest rate, or, something has to give. So that's what we're ultimately trying to help you visualize and understand. In a full quality of earnings report, that typically happens post LOI. So after you've already signed a letter of intent, then the seller might be, is going to be more willing to open all the details of their books and let you talk to their accountant and dig into the details and send you, maintenance logs of their fleet of vehicles and all these sorts of things, right? You're probably not going to be able to get that sort of detail before you sign a letter of intent and really agree. So again, kind of two different things that we're looking to do with the quality of earnings sniff test and a full report. And I would just say, we at ProjectionHub, we only do the quality of earnings sniff test. We are not auditors. We are not going to be digging into journal entries and running analysis to try to catch fraud or anything like that. We are just utilizing the data that the seller provides and kind of looking at it as if, hey, if we were buying this business, what from a financial perspective, what would we be concerned about, and trying to help give you that insight. So just wanted to kind of talk through that because I'm getting a lot of those questions lately, and I'm just hoping that would be helpful as you're kind of considering, is a quality of earnings report right for me in your situation. So if you have any questions, please reach out to us at support@projectionhub.com or leave us a comment in the comment section of the video below. Thanks.